All right, today we're going to dig into a really fascinating stock report for a company called L&T Technology Services, or LTTS. And right off the bat, it presents this classic puzzle for investors. How can a company that looks almost perfect on paper not be a screaming buy? Let's break it down.
Okay, so here it is, right from the start. On the one hand, you see this fantastic financial health score, an 8.2 out of 10. But then you look at the final recommendation, and it's just a hold, not a buy. So what gives? How does that make sense?
And that is the big question, right? It's a contradiction that any smart investor really needs to get their head around. So let's unpack this analysis and figure out exactly what's going on.
All right, first things first, before we get into the numbers, let's get a handle on what LTS actually does and what makes them such a force to be reckoned with.
So in simple terms, think of LTTS as the elite engineering team, the brains, really, that huge global companies hire to invent and design their next big thing. They're the ones behind the curtain, totally focused on super high-end R&D.
And we're not talking about some niche operation here. These guys are deep into the most critical, most innovative industries out there. Everything from making cars smarter to designing cutting-edge medical technology.
Okay, so now we know who they are. Let's get into the why. Why this report sees LTTS as such a fantastic top-tier company. Let's build the case. Let's use an analogy here, because it makes this super clear. Picture LTS as this absolutely gorgeous, perfectly constructed house. The quality is just undeniable. The question isn't whether it's a good house. It's all about the price tag.
First off, look at its efficiency. A return on equity of almost 27%. That means for every single dollar shareholders have in the company, LTTS is cranking out 26 cents in profit. That's fantastic.
And they're not just sitting still either. They are growing and growing fast. Revenue is up more than 16% from last year, which tells you the demand for what they do is just surging.
This is a big one. Look at this number, 0. They operate with 0 debt. That's so rare, and it gives them this incredible financial stability, no matter what the economy is doing.
And it's not just one or two things. You pull up a list of their key financial ratios, and it's just a sea of excellent ratings. I mean, from top to bottom, from liquidity to how much money they make, this company is just firing on all cylinders. And this kind of performance doesn't just happen by luck. It's built on what investors call a moat, a massive competitive advantage. They have incredibly deep knowledge, huge contracts with Fortune 500 companies, and a giant patent portfolio. You can't just wake up tomorrow and decide to compete with these guys.
So let's just recap for a second. The picture we're getting is, well, it's pretty much a perfect company, right? Growing like crazy, no debt, super profitable, and tough to compete with.
And this is where the whole story takes a sharp turn. Because, and you got to remember this, a great company is not always a great stock. They are two totally different things.
Which brings us to the big plot twist. We've talked about the quality of the house. Now let's talk about that price tag. It's all about valuation.
I mean, look at this. It's the complete opposite of what we just saw. All those excellent financial scores, now we're seeing poor right across the board on the most important valuation metrics. The market thinks this company is pricey.
Let's put some real numbers on this. The price-to-earnings ratio, that's just a fancy way of asking, how much am I paying for each dollar of profit? For LTTS, you're paying over $47. For its competitors, the average is around $35. That is a huge premium.
So, how do we square this circle? A perfect company, but a crazy expensive stock. To figure out why the final recommendation is a hold, we've got to look under the hood at how the report actually scores everything.
So here's the secret sauce. The final score isn't just, adding everything up and dividing by 5. It's a weighted system, which means some categories are just plain more important than others in the final calculation.
And here's what that looks like. You can see the big chunks, right? Financial health and growth together make up half the total score. But look over there at that pink slice. Valuation. It still accounts for a crucial 15%.
And here's the key takeaway from that chart. That little slice for valuation, even though it's only 15%, that really low score, just a 5.5 out of 10, it acts like a heavy anchor. It's powerful enough to drag the amazing scores from everywhere else down into just the good range. And this quote from the report just nails it. It sums up the entire dilemma perfectly. LTS is a high-quality company with strong fundamentals. That's the perfect house. However, current valuations appear stretched. That's the pricey part. It means there might not be much room for the stock to go up anytime soon.
And this really brings us to the biggest lesson here. The one thing you should take away from this whole analysis.
You have to learn to separate the company from the stock. A fantastic business is not always a fantastic investment, at least not at any price.
So we're left with a question, and it's a question you should ask yourself with any investment you ever consider. We know LTS is a high-quality company. The market knows it too and has priced it that way. So the real question is, what's the price you're willing to pay for quality?